Have you ever wondered why you or any other trader that you know may have been trading for some time, but at the end of the day, you find out that you are not profitable, even though your win rates may be high, even though your fundamentals and your technical analysis is right on point. You check your records, you seem not to be profitable at the end of the day. This is because you may be making a lot of wins, and then a few losses will just end up wiping or blowing your account. I see this happen to a lot of people, especially newbies. When not just newbies and intermediate traders, they come into the market and they trade. They are very, very good when it comes to technical analysis or their fundamentals. But each time they buy a prop firm account or each time they fund a new personal account, they get frustrated at the end of the day because they keep blowing their account over and over again. A very common enemy for most people who are starting their hands newly in the forex market or who are even intermediate traders is risk management. A lack of knowledge of risk management is the most dreadful mistake that a lot of traders out there make, which is the cause of them always, making results, but at the end of the day, blowing their trading accounts. And this is not encouraging, okay? So that is what we're going to be discussing in today's video: risk management, everything that has to do with risk management. So if this is something you'd like to learn about and how it's going to help you in your trading journey, then stick to the end of this video. Hi and welcome to my channel. If this is your first time, welcome. If this is not your first time, welcome back. You already know the reason for today's video, but before we get right onto it and get carried away, please hit the like button, subscribe to my channel, and turn on post notifications so that you encourage this channel. So let's quickly break down everything we'll be learning today into smaller bits. First and foremost, we are going to be looking at what is risk management and why it is important. Okay. Then we're going to be looking at position sizing or lot sizing, knowing the perfect lot size for your trade, right? We're also going to be seeing how to calculate the best lot size for your trade, right? So first things first, what is risk management? What is risk management? Risk management simply refers to the strategies that a trader adopts to help preserve their capital or portfolio and keep losses under control and have a good risk to reward. Forgive me, I'm not reading directly from it. I'm just you can read through, but it is basically every single thing that you do to preserve your accounts, all right? Because you only have good chances of being in the market in the long run if you understand risk management, all right? Otherwise, you end up, like I said at the introduction of this video, you just end up blowing your account, even though you know what you're doing, technical analysis wise or fundamental analysis wise. Okay, so the goal here is to always risk little to gain more. All right, that's where a lot of traders get it wrong. All right, most traders are just here to make quick bucks. Trading itself is a long-term game. Okay, trading itself is a long-term game. So whatever you are doing, you should be able to preserve your capital so that you would be able to sustain your account through the good and the bad days. Because trust me, there are going to be very good days and there are going to be very bad days. You are going to have winning streaks, you are going to have losing streaks. What keeps you longer in the market so that you'll be able to enjoy the good days is your risk management. All right, but the thing is, a lot of traders just want to, especially newbie and intermediate traders, just want to go into the market aggressively and put out every of their portfolio out, and if the trade doesn't go in their favor, they end up blowing the account. So if this is you, I'm sure you must have already started seeing where you may be making mistakes on how you approach the market. Okay, then what you should know is no technical analysis or fundamental analysis strategy is the holy grail. All right, it doesn't matter whether it is a free or paid course that you got. No strategy gives 100% win rate. I'm sorry to break that to you. If those you respect in the forex market have told you before, there's no holy grail. In fact, the holy grail in trading in general is risk management. Whatever kind of trading that you are into, whether it is forex, whether it is into stocks, whether it is crypto, whatever, you must learn how to manage your risk. You must learn how to manage your risk. That is what keeps you here for a long time. All right, because there are some days where your analysis, where your strategy, no matter how good it is going to disappoint you. Unfortunately, it is going to disappoint you. I don't want to be the bearer of bad news, but that is the reality. Okay, and it is important that you keep your account long, you keep your portfolio, your account long enough for you to enjoy the good days, because the good days are coming, so also the bad days. Okay, um so this is essentially why you need a very good, you need to understand risk management first and foremost, and then have a very good risk management strategy. Because what this helps you to do is that it makes you retain the trust you have in your analysis. All right, because a lot of traders usually wash out, and they, even though their strategy may be working, they just end up not believing in it, believing in forex in general, believing in trading in general, because they have lost money in the past. And this is not because their technical analysis or their fundamentals is not good enough. It's just that they did not know how to manage their risk and psychology, to be in the market long enough to enjoy the benefits of whatever strategy that they use. Okay, so that is essentially it. No fundamental or technical analysis strategy is the holy grail. The holy grail here is risk management. Okay, so I'll give you examples of two traders, right? Let's say trader A is Donald, trader B is Chidalo. So in the forex market, you would find two sets of traders: the ones that are really aggressive and the ones that are conservative. All right, the ones who understand risk management and the ones who do not understand risk management. So let's take these two traders for example. Let's assume that the both of them have initial capital of $1,000 each. Okay, and both of them take the same trade. So let's not, because of course trading is subjective, so let us not assume that both of them are trading different strategies, and it made one to have an edge over the other. Let's just assume that both traders are getting, let's say they subscribe to a, what do they call it, a signal group, right, where they get their trades from, and both of them are essentially just, I don't, I didn't say you should depend 100% on signals, but for this instance, I'm just saying these two traders are solely getting their trades from a signal group that they both subscribe to. Okay, so because of this, they are having the exact same trades, the exact same trades. All right, the same win trades, the same losing trades, the same exact same thing with the same capital. Okay, so if, since they are using the same signals, right, I don't want to say they are using different strategies, all right, because of course some strategies have better edges than other strategies. So for this example, let's just assume that the both of them are doing exactly the same thing, because they are getting their signals from the exact same group or the same community or the same program where they're getting their signals from. So both have the same win rates, same risk to reward, right? Risk to reward is something else. So let me just quickly rush that. Risk to reward is essentially you risking small to get big. So if it is a strategy, if it is a signal that doesn't, that what you are risking or what you are putting into the market is way bigger than what you can potentially get, that's not a good risk to reward ratio. All right, so if you are putting in $10 into the market, you should be able to, at least whatever strategy you are using or whatever signal you are using, should be able to potentially give you a 200% ROI. What I mean is, a one to, if I'm putting in $100, I want to be making $300 back. So some traders go as low as $200 back, but I personally don't do that, right? But risk management is simply just being aware that you whatever you're putting in, whatever you're willing to risk into the market, you are making times 2 or times 3 or times 4 and above of it. Okay, so that's essentially what we mean by risk to reward. So if somebody's risk to reward is 1:3, it means that if they are putting in $10 into the market, they want to potentially get $30 from the market. If they are putting in $150 into that trade, they want to potentially get $450, right? If they're putting in $150, they want to potentially get $450. If they're putting in $1,000, they want to get $3,000. If they are putting in $10,000, they want to get $30,000. So that's essentially it. It's not difficult. So let's get back to what we were saying. Let's say both of them have the same win rate. The signal provider has a win rate of 40%, right, across 10 trades. So what I mean is, for each 10 trade, right, they get 4 wins and 6 losses. All right, that's 40 to 60, right? 40 to 60%. So if they take 10 trades, they get 4 right. They are right 4 times, right? And they are wrong 6 times. That's what I mean by the third bullet there. So both have the same win rate, which means since they are getting their signals from the same program, it means they are going to be getting the exact same thing, 40%, 40%. So they both copied the same trade, and they're going to make 4 wins with the exact same risk to reward. All right. But now they are using different lot sizes. Again, bringing us back to what I said initially, that in the forex market you're going to find a lot of very greedy and aggressive traders who want to make quick bucks and run, forgetting that trading is a long-term game. Okay. So, and let's also assume again that the losses, out of they took 10 trades, right? There were 10 signals given, and the first 6 were losing trades, right? Let's it's just an instance. I just want you to get a point I'm trying to drive home. Okay, so the first 6 trade, or let's say the first 5 to 6 trade, ended in losses, right? And then the remaining 4 ended in profits. Okay, but of course, remember that these 2 traders, one is an aggressive trader, one is a conservative trader. So let's see how it plays out in their accounts. Okay, let's see how it plays out in their account. So for Donald and Dalu, for Donald, out of his $1,000 capital, the first trade ended in a loss. That's minus 250 because he was very aggressive. Second trade, he also risked 250. That is, he risked $250 in hope to get times 3, which because they are using a 1 to 3 risk to reward. Okay, so he lost $250, right? He put in 250, he risked $250, hoping to make $750, because $750 is times 3 of $250. It's a simple math. Okay, so the first trade, they lost the first trade, but because Donald is an aggressive trader, he lost $250. Dalu, who is a conservative trader, lost only $100. Second trade, same thing, minus 250. That reduces his capital to $500. For Dalu, it reduced her capital from $1,000 to $800. I'm talking about the second trade here. The third trade too, minus 250, minus 250. So even before getting to the 5th trade, Donald is left with nothing because of how aggressive he is to the market. Okay. On the other hand, Dalu was able to, because she's a conservative trader, she was able to take all of the trades that she got. So at the end of the day, she had minus 100, minus 100, minus 100, minus 100, minus 100. Am I getting that wrong? Minus 100, minus 100, minus 100, minus 100, minus 100, minus 100. That is minus 600. And then on the 7th trade, all right, and then on the 7th trade, remember she still has like about $400 left. So putting $100 into the market again, finally the trades began to yield something. So then she made a profit of $300, another $300, another $300, another $300. This is a hypothetical example, okay? So at the end of the day, you find out that even before the fifth trade, Donald has blown his account because he was so aggressive. He was not able to preserve that his $1,000 equity. Okay, but you can't say the same for Dalu because she was conservative, she was able to sustain her portfolio long enough to begin to enjoy the profits from that signal, even if they are both on the same level, right? Experience wise when it comes to trading. Okay, at the end of the day, that strategy, they may be using the same strategy or the same signal or wherever they are getting their trades from, but at the end of the day, because one trader is aggressive and the other is conservative, one was able to stay long enough to enjoy the benefits of that signal or that strategy. Okay, so at the end of the day, she's getting minus 100, minus 100, minus 100, minus 100, minus 100, minus 100, and then 300, 300, 300, 300. She has gotten about $1,200, right, in profit, plus the remaining $400 that she had left after the $600 loss. So at the end of the day, you find out that this trader is going home with 1,600. That's $600 profit, even though she had a series of losses first, and even the losses were even way bigger than the losses were in number. The losses were 6 and the win trades were 4. But at the end of the day, because she is a conservative trader and understands risk management and risk to reward, she was able to preserve her capital long enough to begin to make profit from that same strategy or that same signal. Whereas on the other hand, trader Donald ended up blowing his account even before the fifth trade. In fact, on the fourth trade, he already blew the entire $1,000 equity. This is what a lot of traders do. This is what a lot of traders are faced with, because they come into the market pretty aggressive, and most times they come into the market with their last card or money for something else, money for bread. Okay, this already destroys whatever psychology that is supposed to help you to stay long in the market, right? So this is why essentially it's not really, most times after getting your technical analysis or your fundamental analysis right, risk management and psychology is something that you have to like pay attention to, because it is what is going to keep you long enough for you to enjoy the benefits of forex in general, or trading in general, not just applicable to forex trading, even to um those who trade stocks, those who trade um synthetics and all of that, and even crypto. All right, this is it. Once you understand risk management, all right, it puts, you know that this market is not running away. To start with, it is not running away, so why go into the market with such aggressive with such aggressive attitude? All right, if you know you don't have money to always come back to reimburse and fill up your account, it's best that you learn how to preserve your capital long enough and have a good risk to reward ratio. So even though the wins here are lesser than the losses, right? I mean, not in monetary terms, I mean in number, the losses are more than the wins. You will still end up profitable. So it means that somebody who even has a 40% win rate still has a chance to be profitable in this market. All right. So this is for those who are always looking out for a wholly perfect strategy that is going to give them a 100% win rate or a 90% win rate. Most times it doesn't even exist. The average trader is still has somewhere around 30, 40 to 50% win rate, 30, 40, 50, 60% win rate, right? If you really see a trader that has 70, 80%, it means that that trader has really gone very far. But I'm just saying, on an average, if somebody can even get up to 40% win rate, that's out of 10 trades, you are sure to get like 4 or 5 or 6. You will still end up profitable as long as you understand risk management, as long as you understand risk to reward, right? You are still going to make profits from this market. So there's no rush. It's not going anywhere. Okay. Just ensure that your risk to reward is pretty good. It is decent. 1 to 3 is decent, right? 1 to 3, 1 to 4. Some people even do 1 to 3, but of course they understand how money management works, so it works for them, right? But on an average, I think 1 to 3 is pretty decent. Okay, and then make sure that you're not too greedy or you're not too aggressive. If not, you blow your account. Of course, I know that you are anticipating that, or you are hopeful that the market goes in your favor. But what if when you start out, or when you start trading that account that you have just recently funded, your trades don't go as planned? All right, risk management is what helps you to keep that account long enough for your edge to start playing out and making you profitable. Okay, so then let's move on to the next thing: position or lot sizing. I made a video on lot sizes some time ago. I will link that video up here so that you can get access to it if you do not know what lot size or lot sizing means, right? But let's get back to it. Lot sizing refers to the right number of units or the dollar amount that an investor is going to trade with. It helps a trader or an investor to determine how many units of an asset they should impute in every single trade, which helps them to control risk and maximize profit. All right, forget about the whole English that was just spoken. Just understand that in the last example that we showed, right? So you may be wondering, how then do I know? Because I know a lot of people come into trading and don't really know how to know. They don't really know how to determine the exact dollar amount that they are using to trade in trade a particular position. Okay, so position sizing or lot sizing helps you to know the exact amount you are to be trading, right? A lot of people go into trades and they just say, I want to use this so and so lot size. I want to use this so and so lot size. All right. I have so and so stop loss, right? I have 20 stop loss, 30 stop loss. They don't know what it actually means, and they don't know the implication of that amount of pips, right? To their dollar. They don't know the equivalent of that amount of pips, right? They don't know the implication of that to their account. So they are just saying 30 pips, my stop loss is 30 pips, 10 pips, 20 pips, 50 pips. They don't really know how much that is going to, what that means, how it's going to affect their equity. All right. So this is why understanding position or lot sizing is actually important. Okay. So how to calculate your position size before you place any trade? You can do it in two ways. Is either you do it manually or you do it automatically. Before we go ahead, this is just a reminder, please give this video a like, subscribe to my channel so that you encourage us. And if you have any questions or any comments or how you approach the market, so please put that in the comment section and I would get right onto it. Okay, so how to manually calculate your lot size that we use. Now understand something: before you even go into any trade, before you hit that buy or sell button, you should be well aware of the risk. You should be well aware of the dollar equivalent. What you're putting into the market, you should know exactly how much you are putting into the market. How to calculate your lot size that you would impute in your trade execution tool, whether MT4, MT5 or any other one that you use. This is how to check it manually. This is how to determine your lot size manually. So first and foremost, you ask yourself, in this trade, what am I comfortable losing? What am I like comfortable losing? So if I have an equity of $1,000, as we use in our example, so if I have $1,000, I want to ask myself, how much of this $1,000 am I willing to risk in this trade, right? So that whether I win or lose, I am still psychologically, I am still okay. I'm still at the point where I wouldn't want to revenge trade. I wouldn't want to FOMO. I wouldn't want to do any other laughable mistake, all right, that will cost me a lot of money. What are you willing to risk? What are you comfortable losing? All right, of course, you want to make profit in the market, but you should understand that there are losses and there are profits to be made in this market. Okay, so I want to ask myself, how much will I lose and I won't lose my cool? That is basically it. That's what I mean by comfortable risk amount. How much will I lose right now and I won't lose my cool? How much of this equity will I lose and not lose my cool? That's what you should be asking yourself. To different traders, it may be different amounts. Some people it may be $10, some people it may be $20, some people it may be $100, some people it may be $500, which is 50% of your account. I don't think that is wise. All right, but to start with, you shouldn't put all your wealth or all your income into your trading account as equity. No, that's not advisable. But whatever you have funded your account with, ask yourself how much of that. Some people do it in percentage. Some say I won't put more than 1% every time I want to trade. So I won't put more than 1% of my equity in a single trade. Some people, they don't go past 3%. Some people, they don't go past 5%. Okay, it depends on what you are comfortable, what your risk appetite, what you have, what you are comfortable risking. That if you risk it and you lose it eventually, it doesn't affect your cool, it doesn't affect your sanity, so it doesn't make you jumpy. Okay, you are able to allow the market play out and keep your cool. How much is that would you risk and you will not feel it? That's what I'm asking. That's what I want to ask myself first. It may be different things for you. So let's say in this case I have a $1,000 account, and I have let's say I want to, if I risk $100 and I lose that $100, I won't cry myself to sleep. So let's say I won't cry myself to sleep if I if I risk $100 and I lose that $100. So that is my comfortable risk amount, right? I'm going to put that down. So you can calculate with me if you have a calculator close by to you, right? So let's say my account is $1,000, but my what I'm comfortable risking on this trade is $100. I put down the $100 over stop loss times value per pip. Okay, stop loss, let's say the stop loss for that, I'm trading GBP USD. Let's say I'm trading GBP USD, and what I'm comfortable risking is $100. Okay, and my stop loss is about 20 pips. Okay, and the value per pip, let's say I want to use a standard lot. All right, let's say I want to use a standard lot. Remember, I made a video on standard lots. Yeah, I made a video on that. I'm going to link that up here so that you can get access to it if you haven't watched it already. So $100 over the stop loss, which is 20 times the value per pip. Value per pip of a standard lot is $10. Right, value per pip of a standard lot is $10. Value per pip of a mini lot is $1, right? And value per pip of a mini lot is, I think, 0.1, right? But that's not what we're discussing in this video. But once you understand that, all you have to do is just do it manually. What I'm comfortable risking, 100 over 20 pips times the value, which is 10. So that makes me to understand what lot size I'm going to impute in my MT4 or MT5 or any other trade execution tool that I'm using. All right, so this method is good. It helps you, like, you understand what you are getting into, right? But it's a bit cumbersome, especially because of the quote currencies, right? It is not the formula is the same thing, but it may not really make sense to apply it to every single, because this is GBP USD, where USD is the quote currency. In some cases, USD may be the base currency. If you have not watched the video on base and quote currencies, please check that out here. But essentially, it may not be the same for all, because sometimes USD may be the quote or the base currency, right? But right now, there are very good tools now that are very common now, that you can just automatically impute the figures that you want, and it tells you the lot size, the best lot size to use. So what automatic pips calculators are going to do for you is that they're going to save you a lot of time and energy. Instead of you to manually calculate your position or your lot size for each trade you want to get into, you can just quickly do that within 20 to 30 seconds, right? It is pretty simple. I've laid that all down in this video right here, so you can just click on it and check out how to properly determine your position size or your lot size that you use before you go into any trade. Click here for that video.